Poland, Ohio, where I grew up, and they have a statue of me, the first son of Poland. When my
I thought you were going to
mayor.
say a statue of you.
Well, it is of me. It says the first son of. My dad was mayor, which made me the first son of Poland.
Nice. Hey everyone, welcome to today's Tech Talk Tuesday with David Blake. My name's Rachel. Today is August 8th, 2023, and today we'll be talking about the weekly market letter from last week, as well as some looks into the SPY. David, how are you today?
I'm doing well, thank you.
Great, let's jump right in.
Okay. Well, last week stocks struggled a little bit, and we were a little bit cautious to start the week as we rolled into August, and then we ended up with the surprise downgrade of U.S. credit. The rating went from AAA to AA plus midweek, and that originally sent stocks, spiraling down, and they kind of bounced back, and then actually Friday we were up again, and then going into the weekend we sold off the last half of the week, ended up at the lows for the week. That snapped a 3-week win streak for the Dow and for the S&P 500. Now, after the credit rating downgrade, we did see the longer-term T-bill yields go up. They actually hit their highest level since last November. I think the 10-year got up around 420, which was right around where it hit up there on the high. I would expect that probably maybe 4.25 if we see any kind of more take-up here over the near term. That could be the CPI on that we get, I think, on Wednesday or Thursday of this week. And that's going to be a big market mover, and I think you'll probably see some choppy trading going into that. But anyway, then we came in with this weaker than expected July jobs report on Friday. That actually brought the yield back down to 4.05. So it was a pretty good drop once we got the jobs report. Earnings were mostly ahead of estimates. And according to FactSet Research now, about 80% of the S&P 500 companies have delivered upside surprises. That's a little bit more than normal, not a lot. And then the upside surprise hasn't been real big, but it's, if they lower expectations enough, you're always going to beat the earnings estimate. So that's kind of what we hit with here. Okay, we also had crude oil prices move higher. That's the 5th consecutive week for crude oil prices, which is, it's a little bit inflationary. The core CPI this week won't reflect that. But you had OPEC Plus extend their production cuts, which includes Russia. They're trying to keep the oil prices up. And then we saw a larger drawdown in inventory than what we were expecting. And that got oil up around 82.63. Now, we talked a little bit over the last couple of weeks about the XLRE, the energy sector, was one that looked like it was breaking out to the upside, and that the oil stocks would be a place where you may want to put some fresh money. I still think that's probably true. I think that they probably have more upside going forward. Your Chevrons, your ExxonMobil, and we talked about Devon Energy and a couple other ones. So you may go back into the industry group analysis and look at some of the oil integrated majors and maybe some of the oil services and that type of companies and take a look at those, see what's been upgraded or what is strong. Now, as far as the, with that rise in rates, pretty much beat up all the rate sensitive and growth sectors. Utilities was the weakest market group. That was down 4.5% last week. And that was followed by losses in technology, communication services, REITs, and healthcare. They were all down more than 2%. And actually, energy, we just talked about, was the only sector last week that was able to post positives. And that was, again, strength in the oil stocks that we had last week. And so, like I said, at the end of the week, we had, we saw the Dow and the S&P 500 snap their 3-week win streaks. And then we had the NASDAQ, which down for the second time over the last 3 weeks. Okay, the technical condition of the market deteriorated last week. We had the S&P 500 and NASDAQ backing off their 16-month highs, and then we saw the technical indicators actually flip into neutral bearish readings. MACD, which measures the short-term trend, is negative for all the indexes, and then momentum is measured by the 14-day RSI. It's flipped back into neutral, and it's continuing to slow. Secondary indexes, which include the transports and the small cap Russell 2000, they're still showing relative strength, which is kind of positive divergence, but they're not. They're also showing signs that they're kind of slowing down. And then the semis, which helps to pull the sector down in general, it was down 4% this week, and it actually flirted with a 50-day moving average. We want to kind of watch that. I think I wrote in there that the 50-day moving average on the stock is around 36, 35. So we want to, again, that's about 30, 35 points lower than where we finished up on Friday. We want to watch to make sure that that 50-day holds the index. If it doesn't, that could be more weakness for the tech sector. And then we also had, brought up the last couple of weeks with the small cap Russell 2000, we'll look at here in a minute. We have what many technicians call a double top pattern. It's kind of bearish. We need to get that. If we're going to have more upside, we need to get the small caps up above that 1990, 2000 area. Okay, breadth was kind of mixed. You had the NYSE and NASDAQ advanced decline lines both lost ground. The NASDAQ saw more new 52-week lows and highs during the period. Actually, it's about even, actually. But then the NYSE still recorded more 52-week highs than lows. In fact, I think we had 308 new highs on the NYSE to only 75 new lows. So something that we look at. We also saw that investor sentiment still backed off just a hair. The retail investors are still close to where they were in November of 21. We also saw the hedge funds in the National Association of Active Investment Managers Exposure Index. They had been on margin the week before. They dropped all the way down to 78.5% invested. But then the percentage of bullish investment advisors, which is more than newsletter writers, they were up for a third straight week. They hit 57.1%, and that's also the highest since November 2021. If you notice here the last couple of weeks, a lot of these indexes and a lot of some of the sentiment readings are very similar to getting up to where they were in November of 2021. That's where the NASDAQ peaked out before we started to pull back. So that's just something. It's not a sell signal in itself, but it is a little bit worrisome. It just raises a red flag that we want to keep an eye on that. So the momentum index fell all the way from 8 down to 0, which means it's neutral. That's how we measure confirmation of the CTI. The CTI, the cyclical trend index, is down to a +3. Looking at that, probably switching over to a bearish configuration here soon. And then as far as our industry group analysis goes, we did see a few of those. We're starting to see some of those industry groups get downgraded. So what that's telling me in general is that we're constating at this stage the recent gains that we've had. Normally, I would as the CTI begins to get near a negative reading, we'll see negative divergences in the different indexes or some of the underlying breadth readings. Even when I compare it to the weekly readings on the indicators, and I'm just not seeing that yet. I think that I do see weakness in there, and but we're not. I'm not getting the signals that I would expect to see that says okay, we're in the process of a downgrade here. I think we'll have some choppy trading going forward this week. We do still have more earnings coming out, but also, like I said on Wednesday or Thursday, and I'm not sure which one. Should have looked that up. That we have the CPI coming out, and that'll be the Fed's big inflation gauge. Of course, they want to see more progress on that, and at some point, a lot of analysts now are saying that when now the economy is holding up, perhaps we could see a tick up in inflation, or maybe even flat. The Fed won't apply. At this point, there's only about a 25% probability that they're going to raise rates in September. But if we have another fall off in inflation prices from the CPI, that'll probably go out the window and extend it out for a while.
Great. Well, you mentioned that the CTI is projected to change to a negative configuration either this week or next. Does that mean you're looking for more downside in the market over the near term?
Okay, well, the CPI, you can read about on the website, and up in the upper right-hand corner, you get to the help section. And everybody can pull up the SPY, which is SPY, which is the ETF for the S&P 500. But as you can see here, we've had several pullbacks. Most notable in February, March area this year, and then also last October. I had to put the Bollinger Band on this chart. Okay, what you'll see is the Bollinger Band, they have a moving average in there, the 21-day moving average. As you can see, back in February, as we were below that middle line, we made a low, then we came back up and crossed it. I think right now what you'll see, we went below that 21-day moving average on Friday, and when that happens, especially with a candle of that size that you see there on that Friday, it means that is you're probably going to go down to the bottom line of the Bollinger Band. That also just happens to I think it comes into play around the 50-day moving average too. Yeah, below that. So we'll kind of watch that. But if that happens, that would be where I'd expect the S&P 500 to go. And we have something called FLD, forward lines of demarcation, that we also look at. The 40-day FLD also was violated on Friday, and that helps set targets that we use. And between the Bollinger Band and the FLDs, it looks like we could see a pullback to around 4,400. Or what would cause it? I think this week, if you get some stocks here that you see that I think are maybe overbought, and maybe some protection you want to put in, maybe you buy a put yourself some covered call, something like that. But if we get down to that 4,400, I think that would represent about a 5 or 6% pullback, which that's not bad. I mean, we haven't really had anything at all. It even had like a 1% pullback since March. I think if we start to see more negative divergences during this week, then we could actually we may actually switch to a bearish posture and a negative CTI this week. The cycle, there's more of an art form. It's not like black and white. We have this, that, and that happens. You kind of have to gauge it with the momentum index and the sentiment index and see where we are. But just know that probably this stage, I do see more downsides. I did have an email during the week that said someone said, well, if you're projected to go negative on the CTI, why did you say in the market letters to buy? That you may want to buy dip rather than sell the rips. And by that I meant I said to the second half of the year, and that's it. What I didn't mean where we have a 150 point drop in the Dow that you jump in there and start buying stock. What I meant was if you watch this thing go down, if we get like a 5 or 6% pullback, and then you start to see the thing firm up a little bit and the AD line start to move a little bit higher, then I think that that would be a signal for you to go ahead and start to pick up more equities, because I think the second half of the year, if we don't see reversal in inflation, that the market could probably go higher from where we are right now. And that's why I said buy the dip. But a dip isn't, to me, isn't a 100-point drop in the Dow on Wednesday. Don't jump in and buy that. But if we do get several days, or maybe a week and a half where you get that 4 or 5%, maybe 6% pullback, to consolidate some of the gains, I wouldn't be afraid to nibble in there. At that stage, you may go into the ETF Center or the industry group analysis and see what groups are being upgraded. We just talked about oil, the XLE. Go ahead and pull the XLE up on the charts, Rachel. We're right here. Okay, you can take away the Bollinger Band on this. Okay, there you can see on the right hand side. You can see that big that gain up there in April on the chart, and then you see where we pulled back down right there. Okay, now if you draw a trend line and draw it from that high over there in April to where we are right now to the right, you can see right there. Okay, we're in the process of we actually are breaking out of that high, and that's a pretty good indication that the energy oil related stocks are probably going to continue higher. So that's one of the areas that I would over the near term probably nibble away at some of those stocks. But some of the other ones I would, just to see how we have them ranked, a little bit more cautious on that. But XLE is breaking out here. I think that's one area that you should be good on. If you go into the industry group in our industry group analysis and look at the different oil services and all that, you'll find some stocks that are still rated strong or strong buy.
David, I have a question for you.
All righty.
On this,
I
you
got an
just said
answer. May not be the right one, but go ahead.
it's better than whatever I can guess. On this particular XLE chart, you just said that if you draw this trend line that I've got here, that shows that we're probably going to break higher. What
Yep.
about this shows that it's going to break higher?
What says that? Well, just the fact that you can see all the technical indicators at the bottom. They're all bullish. That's just one item you can look at on our stuff. But that when you have something like this, that was a sign of a previous high becomes resistance the next time it comes up. Okay, and then when it goes above that, all those people that that were in there, that just the people that bought it that high before, are anxious to get out of it. But once they get out of it, that's weak hands. Then the previous highs become resistance, and when you break through it, then that means you're probably going higher. Now, you can also see on this on the lows, you have like you have 3 spots where it actually kind of really found support. It go down to a certain level down there, and then that meant that it was going higher. Plus, you had the fact that oil prices are going higher. Oil has gone 68 to 80 to 83. Okay, so when you have oil prices going up, and then you have XLE, which is the energy sector, going up, and it's moving above that previous resistance levels. Then your next target on that would be the high over there from January, where we see how to double. Now go to IWM, put that up. Okay, there you go. Now you see this on this one. Okay, you're up around 2,000 back there in June of 22, but we go over here around June, January, we go around February of 22, the one in the middle. Okay, now draw a trend line from that over to the right. Okay, now that again, that's why I said a double top. Now, if you don't break through that resistance level, that previous high, then that means that's bearish. That means that you can't get through it. You had the people that own it there, they're sellers, and no one's buying it back. That means that this one's going low. Now you're getting, so this needs to break above that previous resistance, and then you can start to see then people that are short. A lot of people will go short when it gets up to that resistance level, and then if it breaks above it, then they've got to cover, which means more money coming in there, which will propel it even higher. But if it doesn't go through there, then that means that's resistance again, and that a double top. Sometimes you'll get a triple top. This is close to actually being a triple top, and the further away they are, like say, you don't look at 10 years or 5 years of that, but if you're like 3 or 4 months apart, those are the strongest signals, because that means just not too long ago, we tried the small caps tried to break out, and they stalled out up there. They came all the way back down, and they're getting back up there again. This stage. This is a double top. It needs to get above that, and if it does, then that's positive divergence. That means that it's showing relative strength versus the Dow and the S&P 500. And then if you'd like to see small caps and transport and stuff lead the market higher and lower, which I talk about weekly. And in this case, if we can't get above that, then we're not going to make new highs. And in fact, I said that the Russell 2000 actually was flirting with its the semis were flirting with their 50-day moving average. It looks like this is what is that? What's that blue one? That's 50 or 21?
21.
Okay, so it went through that. If it breaks through that, then maybe you start looking at the 50-day moving average to see if that's the next support level, just to see where that can go. But at this stage, if you see this take the small cap go above, especially 2,000 and close up there, then that means we probably have one more little spurt for the market before we start to go down.
Very good. And then I have one more.
And you also have seasonal patterns too, and August, about mid-August into through September is seasonally a very weak time in the market also. So you have to keep that in mind too. The seasonal patterns, they don't sound like much, but they actually have a lot. But then the big thing that I'm looking at, I wish I had seen it on last Friday before I wrote this thing, but these FLDs that we have on the charts, you've broken the 20-day night, and you broke the 40-day on Friday. Now you're looking at 4,400 over the near term here as a target, which these things are pretty accurate. So we'll have to see how this thing goes.
Okay. And then I have one more question for you because I'm not experienced at all with Bollinger Bands. So with the Bollinger Band, looking at this, there are places where it's a lot thinner and places where
Yeah.
it's a lot thicker. What is sort of the meaning? How does a Bollinger Band work?
Bollinger Band works off of a trading range, kind of a trading range of volatility of a stock, and as it narrows, that means the volatility and range of the stock is narrowing. Now, and when it gets, sometimes you'll see these things get real close. When they do, that's usually a sign that then you're going to break out one way or the other. It doesn't tell you which way you're going to break out, but when you have those consolidations, it'll, when you see that they're going to get wider and they come together, and when they come together, like over there, the last one was over here, I guess the 1st of July, it kind of squeezed together a little bit, and then we broke out to the upside. Now, now you'll start. Now you see this upper band here on the far right is turning over, and the bottom band's turning up. So it's starting to squeeze together. When it's wide, you're in your trend, but you look for it to squeeze. The best example, I guess, is back there, maybe around December, right around in there. You had a squeeze in there, and then again, you don't know which way it's going to break, and in this case, it broke lower. The way you can measure that would be if you put up the ADXR with the DI and DI plus DI measure and see which way that's going. Because if you see the whichever way it starts to break, then you see the ADX start to move higher and lower. And that signal line doesn't tell you. That signal line will just tell you if it's rising that you're trending. Because it could be trending lower, it could be trending higher too. So that's something that you can gauge with that too. That probably doesn't really tell you much, but anyway, that's when they squeeze together like that, that's when you can expect to start to see the market break one way or the other.
Awesome. Thank you for that. I appreciate it.
And that's all I got for you. But just be careful about the CPI. That's going to be the real market mover that comes out either Wednesday or Thursday.
Great. Well, thank you so much, David. If anyone has questions for David or anyone else on the MarketEdge team, feel free to reach out to us using that chat now button in the bottom right-hand corner of your screen, or shoot us an email at support@marketedge.com. We look forward to hearing from you, and we'll see you next week. Thanks so much. Bye-bye.